Right, let's go to Stephen Harvey. He's the Chief Investment Officer at Sagard Wealth. He joins us now to talk about what's been going on in the market. Stephen, thanks for your time today.
Oh, thanks for having me.
So we've seen the TSX do a bit of a run. It had 3 record high closes Thursday, Friday, and yesterday, I guess. Why do you think we're seeing that? What is Canada or the TSX benefiting from?
I think one of the good kind of relative stories of the Canadian stock exchange this year versus, say, the S&P 500 has been an material overweight in materials, excuse the pun. In the TSX, it's approximately 11% of the index is in material stocks, whereas the S&P 500 is about 2%. That's a pretty big difference, and it's a sector that's run very hard this year. I think the TSX subsector is up something like 27% this year. It's responsible for 40% of the returns of the TSX this year. So it's just a big difference between the allocation sector-wide between the two indices.
A lot of it is gold, I guess, doing that run-up.
Yeah, gold. And what you've seen this year, unlike last year, you've seen the gold miners really participate alongside the price of gold, as you've seen these free cash flows that these businesses are generating, and the return of capital to shareholders is really what the management's talking about now.
Can you tell me what you're seeing more stateside with Treasury yields surging today? I know that the American downgrade, the credit downgrade is playing into this, but can you expand on that?
Yeah, I think the market's concerned, like the U.S. Treasury owes $36 trillion to their own citizens and to the rest of the world. It right now costs $1 trillion a year just to pay the interest expense. That's more than the U.S. spends on its defense budget every year. So the market's starting to get concerned around, is this a level sustainable, the level of debt in the U.S. Treasury market? And if you look particularly on the back end of the curve, you've seen the 10 and the 30-year really start to become a little bit move away from kind of the long-term policy of interest rates. So it's very interesting. It's getting the market kind of a little bit spooked. And I think you saw that reaction from the bond market around the tariff concerns and how much they, the reaction was really kind of from the bond market and Trump making a U-turn basically based on what the bond market was telling us.
That being said, the credit rating downgrade was not a surprise. This was widely expected. So do you think it'll continue to have an effect moving forward?
I don't think that's really the concern. If you look when the U.S. debt got downgraded before, it was a little bit more material. This was a relatively minor bump, let's call it. The trend had already been playing into it. I think those who are focused on the bond market were already factoring this in. It's just where do the long-term Treasury yields go from here is really kind of the great unknown.
Let's talk about investing strategy then at this point, because some people have been moving outside of North America to try and get their hands into other markets just for diversification. Is that something you're looking at?
Yeah, I think you've got to kind of follow the flows. And right now, we think a lot of the flows are from outside of the US. And you're seeing places like Japan, for example, we think is a fascinating market. This is a market that was faced with 30 years of deflation. Deflation's a terrible economic environment to be within because no one wants to spend any money because everything's cheaper tomorrow. So they've deferred spending. And now you're starting to see the Japanese consumer start to spend more money. And you're starting to see the market react in positive ways. At the same time, you get to enter that market with the yen at 35-year lows coming into this year. So we think there's a couple of ways to win in Japanese equities that make it pretty interesting. And I think that's kind of where you're seeing some of the flows. The marginal flow is away from the US and into other parts of the world.
What do you think has led to that turnaround in Japan?
There's a lot going on in Japan around the way that corporates react. So it used to be very much that the board of directors of those companies or management of companies almost managed the companies for themselves or for their, the cross holdings they had for other businesses. Now, because of the action coming from the Bank of Japan and other regulators in Japan, is much more focused on them returning value back to shareholders. So the boardrooms are very different and the way that they react is very different. And you've seen Japanese stocks react quite differently because this change in mentality from the management of these companies is much more about shareholders and much less about management.
Let me ask you about gold and where you think it's headed. We saw it go dramatically higher, of course, when all the tariff announcements were coming through. People weren't sure sort of where they wanted to put their money. It went into gold. It's come off of those highs now. What do you see moving forward? We're in that sort of in-between spot with trade deals.
Yeah, I think with the what you see is if you look at the U.S. market, for example, they have a big trade deficit. They buy $1 trillion worth of more of goods than they export. But that has to come back in the form of capital flows back into the country or back into through investments. But if you start to see a slowdown from tariffs of the trade levels, then those dollars have to go somewhere else. They have to find somewhere else to go. So as the flows are moving out of the US into other currencies, people tend to use gold as that first stop, as that kind of reserve and hold until they find where else in the world they want to invest. And I think that's where we're seeing right now. I think that's more of the kind of, let's call it the technical stuff that's going on. But on the secular side, central banks around the world are continuing to buy gold. And I think that's really the big, strong secular force. And it's, do we continue to see that happen or not? If it does, and if central banks continue to replace dollars with gold, then this run could go on for quite some time.
What are the asset types you like right now?
We tend to be very heavily invested in alternatives on behalf of our clients. And it's really because it comes back to kind of the idea of the markets are super noisy right now. The noise can be really captivating, but it can be very paralyzing. If you invest more in alternative markets or private markets, you're a little bit away from the noise. You can focus a lot more on the signal. Give an example is over 80% of the companies in the US with greater than $100 million of revenue are private companies. So if you're only focusing on the public markets, you're exposing your clients to only 20% of the opportunity set, 20% or less the opportunity set. So we like the opportunity set around not only buying private businesses through private equity, but also lending to them through private credit.
Stephen Harvey, I've got to leave it there with you, sir, but thanks for your time. Stephen is the Chief Investment Officer at Sagard Wealth.